everyone to today's webinar. We will be discussing about a very important and interesting topic, which is how should startups recognize and record their revenues, because clearly it seems like they need to be educated on it, especially the bigger giants in edtech industry, since we are seeing most of the concerns there. And since revenues are linked directly to the valuation of the company, because of which the blowing up is shown and books are cooked, we are wanting to know from people like Shantanu, Abhinav, and Atul today in the webinar as to how we can course correct our ways and land into a position which is more correct from a governance perspective. But I won't speak much because I know there's a lot to be discussed, and I'll let the experts do the talking. So quickly, to do the introductions, I would request the speakers, starting with Shantanu.
Hello. Hi, good morning, everybody. My name is Shantanu Surpre. I'm a corporate lawyer based in Silicon Valley. I have many years of corporate and cross-border experience. I focus on venture capital and private equity transactions, and most recently Web3. I'm licensed to practice law in the US, in California, Nevada, and New York, as well as the UK, plus India, and I'm getting admitted in Hong Kong, and I have law degrees from Oxford and Columbia. I think this topic is a very relevant topic. We're seeing more and more startups, certainly headline news in India in particular, but it's happened all over the world. So it's a very relevant topic.
Yeah, could you mention about those geographies? Because now we are more interested to know about how startups in those geographies are acting when it comes to revenue recognition. But moving on, Atul, if we can have your introduction. Your introduction, Atul.
Yeah, sorry, Radhika.
Okay.
So good evening to all of you. Good morning. I'm partner at KNAV. We are an international accounting firm. My role within that firm is being the global audit partner, oversee audits across jurisdictions, which are the US, Canada, UK, Netherlands, Singapore, and India. Obviously, a lot of those audits end up being with respect to startups, private equity firms, full-grown multinational companies. Quite a few of them are actually going through the IPO route through NASDAQ or NYSE, or maybe even through, the Indian Stock Exchange for that matter. So it would be interesting to kind of, hear the tidbits from Shantanu and also from Abhinav, and take this conversation forward.
Yeah, thanks, Atul, for that. And it'll be very interesting to also hear from you as to what accounting practices do you look for while signing off the books of startups. And I have this very interesting question that if not Deloitte, will KNAV do the signing off or Byju's financials? But we'll come to that later on. Abhinav, if you could introduce yourself.
Hi, thanks, Radhika. Good evening and good morning, everyone, depending on where you are. So I'm a senior director with FTI Consulting India Private Limited, part of the risk and compliance team, where we help clients in mitigating risk and managing complex challenges pertaining to risk. I'm a chartered accountant with close to 16 years of experience in forensic accounting, with internal vigilance, internal audits, and overall risk management as an overall service profile. The topic today is very relevant, as I was catching up with Atul prior to the webinar start as well, and it's and there are a lot of interesting key takeaways that we can discuss throughout this session as to what the trends we are looking at and what we can expect in the near future. So thanks for having me, and look forward to a very engaging conversation with all the panelists today. Thank you.
Thanks, Abhinav. With your experience in forensics and diligence, I'm sure you'll come up with a lot of interesting examples in the course of the webinar. With me, I have Divakar as my co-moderator, and I'll let him do the opening.
Sure. Thank you, Radhika. So my first question is to Atul. So we see there are IFRS and GAAP's accounting standards which provides guidelines on how you should recognize a revenue. Why do companies end up deviating from it, and why do some auditors end up signing on such deviations? If you can highlight on that.
Yeah, well, let's talk about the gaps in GAAP, right? So No question about that. That's a good question, Diwakar. One is the complexity involved. I don't know how far I should go into the details, but there was a change in the accounting principles. We had IFRS 15, which is also called as the Accounting Standard Codification 606 in the US, which came in and which has been applied now when it comes to public companies for quite a few years. But for new companies, the application has started quite recently. Remember also that if you're looking at India, then all companies do not need to apply Ind AS. So which means they can still be on old Indian GAAP. Now, old Indian GAAP does not adhere to IFRS 15. There is a big change when it comes to IFRS 15. You need to consider issues like principal versus agent. Now, that issue itself can mean that instead of showing your revenues at gross at say $100, because you're treated like an agent, you might have to show only the net commission or the net revenue which you earn, which might be only $1.10. Now that's a big gap between revenue recognition, right? So principal versus agent consideration becomes extremely important. You could look at issues like gross to net. And when I talk about gross to net, we spoke about an edtech company. Let's say there are refunds in an edtech company. Now, if you are going to record those refunds on a receipt basis, that would not be GAAP. You need to have an experience rate which is built in. You need to ensure that you are recognizing the revenues, then the obligation which the company is also having with respect to a possibility of a refund is also factored into the revenue recognition itself.
Right.
You've got subscription models, so those subscription models could mean that you might have different revenues in different years because of the way in which your contract is structured. That could lead to a question as to whether this is actually deferred revenue or revenue and so on. So the timing of revenue also becomes important. So GAAP itself is pretty complex, Diwakar. And given that, I think, the quality of audit, the quality of the preparation of the financial statements, all of those go in when you talk about, issuing financial statements which are actually GAAP compliant. So that's my immediate answer to you.
Sure. And even though there is, let's say you talk about the refunds. So what I often see is that, let's say you book a revenue in a given year, and then there is refunds happen. So if that refund happens post the closure of the financial year, then you end up, when it happens to, so when the happens at the end of the year, after the year, then it happens is that it is in the next year financial for statements, you record that as a refund or a reversal, sales reversal. That's the term that is used by the auditors. So how does that happen?
And that is not GAAP.
Huh? So that
is not GAAP.
Okay. So
No,
because I've seen
the
auditors here sign off on that, like you book the revenue this year, the refund happened, next year we'll take it as a sales reversal. So while the whole objective is that to do the revenues and the accounting right so that there's no situation of a tax evasion sort of thing comes up. That's how generally the thought process of the auditors when they do, the traditional auditors who end up doing the audit here. So this is where all the differentiation happens. But then my question now to the Abhinav and Shantanu also is, it is not unusual for companies who are particularly in capital-intensive, working capital-intensive sectors like engineering to book some part of their revenues in advance, even if they are delivering their projects later. So this is primarily to do with the working capital financing that they need to show to the banks to show that they have come up with a certain amount of revenue because of which because of the balance sheet size, the bank will sanction the loan. And sometimes even for a tender eligibility, they do that. So this is a routine practice that I see over here. And what happens is that in those situations, even though the auditors don't, auditors sign it off in the next year. Sorry, just one moment. So in that case, what happens is that even though you book the revenues in advance, you end up paying the tax applicability, which is there, like GST and those sort of things, which is there, has to be paid in. So so in that sense, why do startups, when the startups are doing why do such problems become apparent? Like what happened in the case of Byju's? Hello.
Well, I can't speak to the accounting issues. I'll speak to the legal issues, something here. What I have seen is that, at least in the U.S. in particular, these statements made to the banks basically need to be honest and truthful. And I think where you have to also, you can include some projections. But where you get into a tricky situation is when you've just basically made up numbers and you put this to the banks, and you are basically trying to get a loan on that basis. And if you saw this in the last U.S. presidential election, the former president actually had this problem. And this is where the New York Attorney General is actually, I think there's a deposition going on now regarding some of these practices. And I think when the former president was questioned about the valuation of his companies, he said, well, it kind of moves from day to day depending on my feelings. And this was one of the quotes. Any of you who followed the U.S. political scene will be very aware of this. And so maybe the former president can, maybe that's a defense for him, but for those of us who don't have access to those kind of resources, that's not going to be a very good defense, that your valuation depends on your feelings. You're going to have a much more robust defense on why you justified those valuations. And there can be a margin of 10, 20% error, but the numbers cannot be wildly out there. And so you're going to have liability from a legal and regulatory perspective if you've just made up numbers to the banks in order to get a loan. It's going to be a problem for you, in addition to shareholder liability. Which will be a separate topic we can talk about more.
Thanks, Shantanu. And Abhinav, your views on that?
So I think Shantanu sort of summed it up pretty well, because those legal issues actually translate into accounting issues as well. Mm-hmm. So we have seen cases where, what happens typically, as you rightly mentioned, in your question, if I got it right, was that companies, what they end up doing is that they present very lofty projections, because that is what the banks look at. So they generally look at 2 years historical numbers, and then they look at, at least 3 or 5 years business forecast. Now, forecast has to be dependent upon, if I talk about some specific points, forecast has to come from a very strong and robust GTM strategy. And then you have to have a very solid basis of translating the GTM strategy into the order intake and the revenue projections that you build. Now, the problem that happens is typically that in order to, so you basically, so if it's a working capital, that the bank is in Indian context, banks typically fund 75 to 80% of the working capital requirement. So what happens is, where do you get the balance 20%, right? So what you do is you start doing some creative accounting processes to show that your revenues are your revenue projections are good, and therefore you'll meet the required parameters that the banks have, internal credit assessment parameters that they have. You start, if I talk about a typical manufacturing company, they start overstating their, receivables just to show a preferable working capital position. And that's where the internal controls in terms of having regular stock audits, through independent agencies, and all those controls that the banks exercise typically prior to sanctioning a loan, they come into picture. So the point is that what is the basis of the forecast that you prepare? Is there a confirmed, or is there a defensible pipeline that you have, based on which you have projected the numbers, that these are the orders, revenues, and this is how they lead to my EBITDA projections? Or, as Shantanu said, it is based on a feeling, because if it is based on a feeling, then you're exposing yourself to a lot of potential litigation with the probably consumers as well, with stakeholders, with shareholders. The directors can, and they'll also end up in litigation. So from an accounting standpoint, if you look at it, what were your historical practices, and based on your historical numbers, are your projections really achievable? So if you're saying that historically my sales have grown at 10% or 11%, but you say that in the next 5 years I anticipate sales to increase by 25 or 30%, then what are you doing to do that? Is it that you are launching a new product which has a new market, or are you in a position where you have like near monopoly or duopoly kind of a situation where you can command a price premium, or do you have a technology advantage? So what is it? So it has to be very defensible, and accordingly your accounting will also run, because remember, once you commit to a particular valuation, then it is very difficult to justify the delta between the actual and the projected numbers. So even if you raise valuation, let's say you prepare very lofty projections, and based on that you raise $1 billion or whatever amount is, then you have to justify it to the board as well as to the stakeholders on the actuals. And this is exactly where, if your business model is not sound, if your internal controls are not sound, companies unfortunately end up resorting to creative accounting processes where they start speeding up their revenue booking. As Atul also mentioned some time back, let's say the revenue is actually due in the next year, but you book it in the current year because you need to show some progress, or you need to show some performance, and this is where things start to go bad. So I mean, these are some of the aspects that we have seen, and which have a direct bearing on the valuation as well as the accounting controls.
But we see also, like, even if you do all this forward booking of the revenues, or do a advanced revenue booking and then do the later on deferred basis, it will all show up in the balance sheet. Like the smart investor will be able to see it. Suddenly you have too much receivables as a portion of your revenue. That's a red flag to watch out. Even the banks will watch it out, those who are giving out the lending. So isn't that something like the investors anyway will do a deep dive on and figure out that, okay, you are forward booking it, and there is now the GST system is also very tightened up. It's not so if you book something, you have to pay the tax right away. So, and gone are those arbitrages in which people were able to play on the input tax credit by booking and then canceling the revenue. So won't the investors be able to spot it anyways? So why resort to this this mechanism anyways?
So I think it's a very fair point, Diwakar. I think the mantra that everybody needs to kind of understand and appreciate is that billing is not revenues.
Mm-hmm.
Okay, just merely billing or invoicing.
Right.
Does not mean that is way back. You might have to go 25 years back, and maybe that's when it was okay to
Right.
see that billing is equal to revenue. So that's not so. And you rightly pointed out, even if you bill and if you don't record revenue, then in that case you need to push to what we call it as deferred revenue, which is a liability, so that the accounts receivable that you have put together is then offset, not through the P&L, but through your balance sheet itself. Right. So remember one thing, see again, in India, if you're a private limited company, there is a compulsion to audit. Mm-hmm. But let's say if you're structured as a US company, there is no compulsion to audit. There is no requirement, statutory requirement to audit in the US. But any good investor is always going to insist on what is called as a quality of earnings report. And in a quality of earnings report, or in India, we call it a full-fledged due diligence, these items are bound to come up. Your valuation is going to suffer. It's not something which you can just brush under the carpet.
Right. Thanks all. Radhika, your floor.
Yeah. So I had a follow-on to that, Atul, as to how should startups be recording their revenues, and why is it that revenues are only the parameter that is linked to valuation, that people would want to swell it up? How is it that they can consider their valuation through other metrics as well and show the investors the confidence in their business?
I guess the reason why revenues become important from a startup perspective, Radhika, I'm going to the later part of your question, is simply because, most of the startups are not able to show EBITDA. You are a little more matured in your cycle, then EBITDA starts becoming a pretty important number when it comes to valuation. But in your initial cycle, revenues basically show as to whether there are sustainable revenues, whether the quality of the revenues is also something which is good. And when I talk about quality of the revenues, we are talking about the customers, the fact whether there are repeat customers, if it is a consumer focused business, if we are talking about larger, B2B businesses, then what kind of businesses are the ones which are basically kind of, giving you the revenues, the predictability of those revenues. Abhinav touched upon that point, as to whether this is because of an initial, we had situations because of COVID-19 when there were certain services, or you can call it certain industries, which were completely focused on the crisis. Now, as the crisis has started to, slowly kind of take a back seat and economies are kind of moving into the next phase, questions are coming up as to the sustainability of those revenues. So those factors also are pretty important. It's just not about the numbers in a silo. Seasonality of the revenue. We have seen certain promoters who pick up the best month of the year and then decide to annualize their revenues and say, oh, okay, now please use this as the multiple. You can't take the best month of the, you have to look at the predictability of the revenues on an ongoing basis,
Right.
So those are the things that I would say, the accounting, practices per se, it's a highly technical subject depending on the kind of revenues that you're looking at. Let's also remember that there are, number of impressions, number of users. There are a lot of other metrics too, which go into valuations. One wouldn't, it would be incorrect to say that the revenue number is the only number which is basically important for investors. But the revenues are definitely part of the overall subjective analysis, even when certain other parameters are used.
Yeah, I was just going to ask you that only, that what happens in the pre-revenue stages of startups, that because they also have certain valuation. So what is it really that counts for those who are not making revenues?
I think in that case, Radhika, definitely I will point towards some of the non-financial metrics which start coming in. We spoke about, we have seen companies, and Shantanu has been part of quite a few of them, where we have seen that, initially it's just a business model. And, you basically provide, there are app-based models which initially provide free service. So in their first 2 or 3 years, what they would basically provide is a subscription service where there is no money to be paid. And it's only once they have got a certain number of users, they will then say, okay, now we are going to charge for this service. And that's when revenues can even come up on the financial statements. So in those cases, definitely, we've got even, nowadays there are cybersecurity services. There are, because that's that's a sunrise industry, a lot of investment going into that industry. We see companies, kind of doing, models where it is success-based. Where if there is no intrusion, if there is, a ransomware, then based on the amount that they are able to reduce in terms of the ransomware fee and so on, they are charging revenues. So you will see quite a lot of, new and interesting, ways in which valuations can happen and would still be deemed to be reasonable.
Right. But Shantanu, coming to you as to, even if the founders have cheated the investors in terms of showing incorrect revenues for fundraising, what are the legal actions that an investor can take against such entrepreneurs and can safeguard themselves from this kind of situation?
That's a very good question. Particularly, I think your question is more about Indian companies who incorporated as a U.S. parent holding company, right? And so that's where the investors typically would have invested. So it's a very good question, because what would happen in that situation is for the investors, they would basically, their strongest claim for legal action would be some sort of misrepresentation, basically saying their investment was predicated on certain things being true. And that's why, in some way, the startup will argue there's some due diligence aspect that, okay, we gave you a chance to do diligence, but even despite doing due diligence, the startup could have misrepresented numbers. So that's the single, I think, strongest lever that an investor has is misrepresentation regarding certain items that the startup held to be true, that the portfolio company. In that case, then you could sue, the investor could file suit against the company and its officers and directors for fabricating figures, for example, misrepresenting, and therefore the valuation was hit, and then basically was sued. Presumably, that usually happens when there's a loss to the valuation, because you need to show damages. And so misrepresentation is one thing. Often what you'll see is during these times of misrepresentation, everything is fine when it's Series A, B, C, and it keeps going up. At Series D, when somebody finds out all these numbers were cooked, then it's when the valuation drops. Then you have damages, and you find people in Series A coming back and saying, "Oh, wait a minute! Even though it was 2 years ago, we're not going to come back with a claim for misrepresentation because we now have damages because our valuation was hit, and then we can show damages." It's very hard to win a case without showing damages, and so you have to be able to show some kind of damages. Or what are you going to get without damages? And so that's one of the important things to show. And so that's the strongest action. And you have seen it in various cases in the U.S. I can't to call a very large public one, but even look at the WeWorks, for example. I mean, WeWorks was another example where I'd have to look, but there could have been legal action taken against the CEO. Against some of the numbers that were made, and certainly there was a very high valuation that was paid, and not only the valuation, but sort of expenses that the startup took itself. Whether there's high salaries or any other expenses, there are lots of things that can be examined at that point.
Got it. And we have a follow-on question from the audience on that, from Krishna, that what are the specific valuation guardrails that these private companies can consider while going public? Since you deal with a lot of growth and late stage companies, maybe you can answer that, Shantanu.
Sorry, just repeat the question. I couldn't catch it.
Yeah. So what are the valuation guardrails that private companies can take while going public?
Well, I mean, I think one of the things is usually this sort of, when it's going public, usually the bankers will play a very important role. I mean, the bankers are basically going to guide your valuation guidelines, right? And so usually they're going to use some other, what they call comps, right? Comparables. So they'll look out in the market and look at your sales and revenues, and then they will compare it against other comparable revenues. And on that basis, they will come up with a number. Now, it's not perfect. It's not a perfect art. And you'll see many times that in India in particular, there are so many startups that went public in the growth sector and they've plummeted 50% from their IPO price. So clearly the bankers do get it wrong. And there could be cases of litigation. I'm not sure about the Indian scene, but certainly the US, if that were to happen, then certainly shareholders could file suit, saying that why did the valuation drop, why compared to the share price, and what they would examine the prospectus and look at that.
Understood. Abhinav, coming to you, if you could tell us some of the examples of. Oh wait, Shantanu, you're speaking something, but you're on mute, I think.
No, sorry, I was talking to somebody else. Go ahead. I'll come back.
Okay, cool. Abhinav, if you could just give us some examples of your life cases that you've dealt with startups where you actually had to conduct the diligence for their wrongdoings. If you can tell us as to how did you go about it and what were the action steps that you took as a firm?
See, I think this one was an interesting case. This was an edtech company, and their business model involved basically getting more and more subscribers to their paid courses, which are called courses on their platforms. And for that, they basically have educators who basically do the classes online. So how it used to work with this company was that the subscribers would have their own student following on YouTube and other channels, and then they would encourage them to take up the paid subscription of which is offered on the company's platform. Now the issue, what we found was that the company's employees, along with certain third parties. So this company had a commission and incentive referral payout scheme basically, and the idea was to get more and more subscribers on the platform because that's how you grow the user base and therefore the revenue base. Now, to attract more users, they came up with an incentive and different commission payout schemes to the educators as well. So if you get more subscribers, you get more commission payout. Simple. But the problem that was happening was that the third part, certain employees, they were basically in collusion with the educators and certain third parties. They were using fake mobile. They were using mobile phones to log into the platform, and then just stay there for 10-15 minutes, because the company had a system that if you log into the particular course or a particular lecture for a minimum number of time, let's say 5 minutes or 10 minutes, it records you as a user. And based on that, it gets accounted for as a genuine user for payment of the incentive to the educator whose lecture was being listened to by the students. Now, what we found that the educators, certain educators, along with the employees of the company, they were using third parties to log in, drive up these numbers, and how they would use, let's say they would buy 30-40 mobile phones and log in through those phones and stay there for a certain amount of time. Now the system takes it as a genuine user, right? And therefore the commission gets accrued to the educator. And this way, a lot of payments were happening. And in fact, if you see in the last 1 or 2 years, a lot of investments have gone into the edtech industry overall. And a lot of teachers, they've left their jobs and come onto these platforms because they pay well. So we investigated this through a lot of business intelligence procedures. We were able to identify who are the people involved, and we were able to identify this modus operandi that they're using mobile phones to log into different. Because we were also perplexed. How do you drive numbers, and how do you drive numbers to such an extent that a person who was, let's say, earning 1 lakh rupees in a particular month, now he's earning almost 10 lakh rupees a month. That's the scale of the difference. So then we figured out that they were using they were buying mobile phones, and buying mobile phones is like an investment of 1 lakh or 2 lakh at max. You can buy many phones, but this problem was widespread. And the core of the issue was that there were multiple issues rather. So one is that their internal policies and procedures were not very robust. Their contracts with the educators were not very well defined. They were not ring fenced in terms of if they had to take an action, how do they take an action against the educators? What are the key guidelines from a compliance standpoint that the educators, employees, they need to observe? So we recommended a lot of. So we recommended to the company that these are the areas that you need to beef up your internal control processes. A lot of data used to be exchanged on WhatsApp or other informal channels, which is the stark reality of the startup culture. Because at the start of the business, you can't be focusing too much on compliance, and this is where exactly things start going wrong. So you chase growth at the cost of compliance, and then it starts to come back to haunt you. So in this case, it was a widespread problem in the entire region. And they had to then take actions against the educators. We recommended to improve the way your contracts are drafted with the employees as well as the third parties. We asked them to improve your control MISs that you have, as to how you track how many subscribers are increasing. Is there a significant jump in the subscriber base? What is the reason for that? Are they genuine or not? So this was an excellent case study, which basically showcased as to how chasing growth at the cost of compliance can really come back to haunt you later in terms of having to deal with employee issues. And then there are reputation issues also, because the moment these kind of issues come out in the market, and they do come out, irrespective of how much you may want to have a confidential investigation, the unfortunate reality is these kind of investigations do in one way or the other start coming out in the public domain, and that's when your reputation starts to take a hit. So this is my perspective on one of the interesting case studies that we found, and there can be more.
Yeah,
But,
indeed, it's very interesting and shocking as to how the differences in the revenues were from 1 lakh to 10 lakh. But tell me one thing as to how do you dig into such cases and get these out? I know that that's what you are known for, but what is it that you actually use as a tool to find these things out?
See, there are multiple techniques that so each investigation is different. You have to first basically identify what exactly is the objective of the investigation. So if the objective of the investigation is to first confirm what is being alleged. For example, in this case, the company wanted us to first identify if at all this is happening, if at all there are fake subscribers coming on the platform, which is leading to an outflow of incorrect commission payouts. So we developed a strategy of first gathering some business intelligence, wherein we through some on some pretext we would interact with educators, with other third parties to identify who are the people involved. We identified who are the educators which are there in the scheme, and then how are they actually doing it? So through a lot of discussions, site visits, inquiries, we were able to identify, okay, they are actually using mobile phones. They're using mobile phones to log into the platform. And then through discussions with the company, we identified they had certain processes. For example, this one, wherein you log in for a certain amount of time, and the user and the system will treat you as a genuine customer. So then we also identified how are they sharing information, which was through WhatsApp and other informal communications. So, and then you have, if you want to dig further to quantify as to since how much time and what is the overall value, then you need to adopt some data analytics techniques. You need to identify, you need to zero in on which are the expense accounts we are looking at. So it really depends upon the exact objective of the investigation. What are you trying to get out of that investigation, right? And then identify a particular scope, because investigation can be never ending. You can keep on expanding the scope of the areas you want to look at, and it will never end. So that's what we typically do. We advise clients that, first you identify what is your objective, what are the key areas we are going to look at. And based on that, we identify what is the best technique that is going to drive the maximum results. Is it business intelligence? Is it forensic accounting, where we look at books and accounts of the company in a very focused manner to identify what are the red flags? Or the third step, which is a bit more intrusive, is, to seize the mobile phones or laptops of the employees and then try to gather some evidence of wrongdoing. But it really depends upon which stage of the investigation you are in. Are you at a stage where you're just trying to get facts, or you are at an advanced stage where you already have some evidence and now you want to, nail it further? So that's how you typically go about an investigation at a very 100,000 feet overview level.
Yeah, you made it actually sound like a CBI investigation full on.
No, that was not the intent. But my core intent was to basically say that investigations are highly sensitive in nature, because you are dealing with employees, you're dealing with your third parties or vendors as well. And there are a lot of reputation issues also tagged to it. So before commencing an investigation, the company needs to be very, very sure, and preferably through an external counsel. That's what we generally advise, that if you are going about an investigation, it is always preferred have an external legal counsel on board, because that gives you the attorney-client privilege as well, at a later stage. So yeah.
Dude, I'm sure this question everyone listening would have, that what's the timeline? I mean, it's so elaborated, the process. How much time does it actually take to come to a conclusion?
That's a very that's a very painful question for most of the investigators, to be honest, because generally it's a mix. One is, of course, it's about the complexity of the issue that you are dealing with. Some investigations can be very simple, but some investigations by their nature can be very complex, right? So it depends upon what exactly is the issue that you are investigating. And then second also is that what is the availability of data and the cooperation from the management. A lot of cases, they get stuck in the investigation phase itself because of these multiple reasons. One is availability of the management or availability of the relevant data and systems to analyze and then firm up your hypothesis. And then it's also about availability of adequate and skilled manpower from the investigation standpoint. It's not that it's always the person who's being investigated is at fault. It is also about what quality of people you put in, and what is their expertise in terms of an investigation. So if you ask me, is there a set timeline to it? No investigator can give you a confirmed timeline that, I will investigate, this particular matter in 2 weeks and I'll get back. And that raises a very important question, Radhika, that a lot of times what happens is companies, they want to just get through with the investigation because they want to show to the regulators or to the law enforcement agency that, look, there was an issue, we acknowledged it, there was an investigation, and here's the report. But what they don't realize is, how was that report achieved? Was it achieved by, pressurizing the investigators to do a hush-hush job and close the investigation? It doesn't really serve anyone's purpose. In fact, that opens up the company as well as the investigator to more potential, litigation risks and, for breach of professional duty and host of other issues at a later point in time. So that's why, rather than the timing or the timeline it takes to complete an investigation, companies should focus more on a logical closure of the investigation.
Got it. But I'll ask Shantanu also this, but before I come to Shantanu, Abhinav, how much, I mean, you said that it's all on the cooperation also of the employees, the founders. What if they don't cooperate? What is the punishment you give them? What do you do?
Okay, so see, I mean, if the cooperation from the founders or the people who against whom you are doing an investigation is not forthcoming, which is generally the case, you have to adopt alternate processes and procedures to do it, right? As I mentioned, you gather through business intelligence procedures, you get some information, you can do discrete inquiries. A lot of times the investigations are board governed. That means, the founder or the promoter are generally not supposed to interfere with the investigation process. And therefore, at times, you may still have access, to the books of accounts. So you proceed with what you have and what you can gather from alternate procedures, and then arrive at, some plausible conclusions or findings. There are alternate processes, as I mentioned, like, imaging the laptops or mobile phones, which is the forensic or digital forensics. So it's not that you can't do an investigation if the cooperation is not forthcoming. In terms of punishment, it is really not the investigator's job to determine what should be the punishment, because that is the core or sort of a sole area, for if the matter goes to the court, the judge has to decide it, right? The investigator cannot and should not comment on in their report as to what actions they should take from a punishment standpoint. As an investigator, you can recommend some proactive controls or some remedial measures that the company can implement to prevent such things from happening. But generally, from a punitive standpoint, in terms of recovery or in terms of taking employment termination actions, it is generally the board of directors along with the legal counsel who are in the best position to decide. Obviously, depending upon what are the terms of the employment contract against of the person or the contract with the person. So it's slightly complex. It's not so easy, specifically when it comes to the punitive actions that companies plan to take.
Yeah, and right now we're in the best position to ask Shantanu about the legal part because I'm sure that he knows the best. So Shantanu, tell us about what the punishment can be and what kind of clauses can you add to the contract from an investor perspective if this kind of a situation occurs where the founder is just not ready to cooperate for the investigation and the investors are, wanting to get the answers.
Yeah, so I think there are a couple of important points here. So one, as Abhinav mentioned earlier, this is really, it becomes a court sort of issue. So the punishment itself would be decided by the courts. Generally, though, what happens is, what I've seen is these investigations are there because the board is compelled. Remember, when you have venture investors, the board is also comprised of the investors themselves, right? Unless it's a very early stage company where the investors are not on the board or the board is so small. But in general, like a Series B, C and up company, the venture capital funds themselves are on the board. And so they don't want to expose themselves to any further liability. So typically they will insist and cooperate, whether the founder likes it or not, that we're going to have an investigation, we're going to hire counsel, and we're going to hire ABC to do an investigation look into this matter, because they don't want their own liability for being on the board, because they have a duty to shareholders. And so I very rarely see an investigation not happen just because the founder didn't want it to happen. I think there was a Zilingo case where a well-known, widely known case, very, a strong founder. Despite that, the investigation happened because the investors wanted it to happen. So I don't think the founder himself or herself could prevent it. The investors themselves will mandate it. And once that happens, then it lays out what exactly happened. And then based on that, any sort of specific action could be taken, whether there was fraudulent accounting, whether there was improper payments, misappropriation of funds. Those would be the typical types of scenarios or incidents that occur. And after that, then there can be specific legal action taken against a specific individual, against the company, against an officer or director, whatever the case would be. There could be a separate matter now if this was widespread and on a different angle. Let's say there was the company was defrauding consumers, like the general public, in their practices. And then that matter could in fact be referred to, at least in the US, to the Attorney General of that state. And the Attorney General of that state will look into the practices run by the company. Perhaps it's a criminal matter. That's the sort of, there's just multiple paths this could take, but these are the types of scenarios that you typically would see.
Understood. Atul, coming to you, I have a very interesting question that, you might be aware of the news that Deloitte has refused to sign off the financials of Byju's, but, they were vetting the audited reports before that also. So it's not like the first instance that the revenues must have reported in a wrongful way. There might have been other events as well, but Deloitte chose to sign off the results and they stepped back at this stage only. So my question to you is that how can accounting firms be in their actions be very protected and measured in terms of signing off such financial reports, and how is it that you go through the process since you yourself come from that background?
Sure. Radhika, I think one of the important points and one of the safeguards that most what we call it, let's call them public interest entities simply because while they are not publicly held, there are private equity or venture capitalists where there are a lot of public, investments within that. We generally recommend that as an auditor, we would prefer to work with an audit committee. And we talk about an audit committee, it is typically independent directors made from the board of directors. Because inherently, if you think of it, the CEO and the CFO, there is a conflict when it comes to the preparation and presentation of the financial statements. Whatever you might call it, human nature cannot change, will not change. So given that, when they have got their bonuses, when they have got their stock prices, when they have got their future valuations, which are directly dependent on those set of financial statements, a certain level of bias requires someone to be, ethically so strong that that is a trait which may not be always found in every human being. So given that the audit committee becomes pretty important, we always prefer to work with the audit committee with respect to the timing of, remember, and again, this might be cliche, but an auditor is not a bloodhound, he's more a watchdog. And, the audits today, the way they are conducted, they basically provide reasonable assurance. The word is about reasonability. And the reasonableness of the assurance that is provided by an audit report is based on the fact that auditors will always sample and not do an audit of the whole population. So given that, there might be situations, maybe in the early stage of a company, when certain issues may not manifest themselves into what we call it as material misstatements. So yes, there could be internal control issues which may be noticed by the auditor. There might be irregularities, let's put it this way, in terms of the measurement of the revenues. But when the auditor looks at the quantum, the amount that is involved, they come to the conclusion that, okay, even though these things are there, they currently do not, at this point, on the current financial statements, it does not seem to impact them in such a way that I need to either give a qualified opinion or an adverse opinion or issue a disclaimer. So it would be unfair to say that just because you gave an unqualified opinion in an earlier year, that automatically means that, oh, you did a bad job. Okay, I wouldn't like to kind of take that as the learning. Yes, it is possible that maybe an auditor has not performed an adequate job and professional standards have not been met. But that's something which would come out from a later investigation. There are reviews which can take place, which can come to that conclusion. When you have companies like Byju's, which are growing at a phenomenal rate. Okay, the size and scale at which they are growing every year is extremely, extremely large. So you will find that in such situations, some of the smaller areas of concern can all of a sudden become larger areas of concern, which might all of a sudden start attracting so much attention. And one more aspect I think which is very important is that when we issue an audit report, we also issue the management what is called as a management letter. Okay, that management letter basically puts down what we term as significant deficiencies. Okay, so significant deficiencies are deficiencies in the internal control of an organization, which together do not make a material impact on the financial statements, but we highlight them. We think it is important that the management needs to know about these significant deficiencies. And there are also those which are called as material weaknesses. Now, material weaknesses typically would lead to a material impact on the financial statement. So both of these are usually, always highlighted in a management letter. The expectation is that the management will work on those significant deficiencies and those material weaknesses and make appropriate changes in their overall internal control over financial reporting to address those. Now, in the next year, when you go back to audit, if those changes have not been implemented, okay, or if the changes implemented are not adequate enough to still mitigate the risk arising from those, then in that case, you end up and then you come back and tell the management, see, we have already spoken about this. We have already given you an idea that you need to change this. You have not yet done that. So now it is not possible for us to continue to give you an unqualified opinion. We are going to issue a qualified opinion. So one has to look at the things in totality. I think, yes, if there is any wrongdoing from an auditor, obviously, an auditor needs to be, taken to the task. But I guess, looking at things in totality is also important from that perspective.
Right. So just to, Abhinav, you have a point?
See, I think I just had two perspectives to it. If you look at the latest ACFE's global report to the nations, what they have been consistently highlighting over the past years as well, that generally it takes around 14 to 18 months to detect a fraud in a typical organization. And that is one. If you look at closer to the home from what the RBI published in its annual report, they have said that, in bank frauds specifically, it can take up to 10 years for a bank to detect fraud. So what we are talking about is not really a very straight-jacketed approach that, why is the auditor today saying that, I cannot sign off this balance sheet because there are issues. Because if we link the two things together, a lot of times it happens is that the genesis of the issue is somewhere deep in the past, and it sort of slowly balloons into a problem of such a scale where at that stage it gets difficult for the auditor to justify his role. And there can be multiple reasons for an auditor to resign or not to sign off the balance sheet, and that has been a contentious issue, no doubt. And Atul would agree to it that there have been a lot of debates around what level of disclosures do auditors need to make at the time of when they finally decide to resign. Do they clearly state the reasons for their resignation or not signing off the audit? So I think it's not a very a simple question as to why is the auditor resigned today. I think the bigger question is, if the auditor is resigning today, then what are those reasons that have led to the resignation today? And are those reasons attributable to a failure in the audit quality, or or is it attributable to the failure on the management? Because remember, the responsibility for internal controls rests purely with the management. It never rests with the auditor, who's just going to audit based on a sample and certain procedures. So that's why I think the lines get blurred at a few places. So just wanted to highlight that perspective.
Yeah. It did add on to it. Yeah, Devakar.
So hearing all these thoughts, I think the best strategy, as we all say, is prevention is better than cure. So staying on this line, what should the steps that as startups or the investors should take so that these sort of situations do not happen? I mean, it's not saying they will not happen, but how can it be minimized? While we already have some of these regulatory mechanisms, like MCA has a lot of reporting requirements that a company has to do for filing, some depending on the size of the company. So, but other than that, what are the steps that companies should take so that to ensure the compliance and to make sure that the corporate governance is on the line, whether they're a small scale, so that doesn't become problem as they grow? So Abhinav, we can start, and then Shantanu can.
Sure. I think a couple of points from a startup perspective is that commensurate to the level of the stage that they are in, they need to invest in a good quality resource who manages their finance, and the compliance functions. So generally, what we see is that from a compliance or a CFO function standpoint, there is lesser importance attached to it, and I think that perspective needs to change, because this is one of the key areas. And second is that setting the tone at the top, where the growth does not come at the cost of compliance, rather growth comes because you are a compliant and you are an ethical company. So I think again it comes down to the same point of having a tone at the top, having ethics and integrity basically as part of your core DNA. And the third is basically, as you grow up, you need to continuously invest proportionately in building up your internal controls, be it in terms of having robust policies and procedures, relevant checks to ensure that they are operating effectively, investing in good quality management, I think these are some of the, and obviously third-party risk management, because that's where a major sort of a risk lies in who are the parties that you do business with. Do you really know your related parties? Do you know your vendors and all? These are some of the aspects. And from a board level standpoint, I would, defer it to Shantanu, who can comment on in a better way as to, from a board perspective, what are the points that are important to be looked at.
Shantanu?
Yeah, in terms of, I don't know how you can actually prevent a lot of these things, but I think just the simplest answer is just some level of corporate governance. That the board, particularly if the investors are on the board, they also face their own set of liability being directors on the board, and they have a duty to the shareholders, which include their own investors, but the shareholders generally. And so I think, whatever the company is doing in terms of revenue recognition, in terms of sales recognition, anything around that, as well as outgoing expenses, that they, whether it's misappropriation of funds or in the Zilingo case where there was allegations, and I think this was true in it was another company, I think Bharat, right, where there were allegations that certain funds were diverted to related party companies. So all those sorts of things that we've seen before. The investors, should be on top of this in some way, and maybe there's so many things going on they can't be. But that's just the best advice: is you have regular board meetings, you have reports, and they're basically doing their job. And otherwise, they'll be open to questions. So you were driving the bus, and you're not paying attention. And what you often see in large public companies is that they'll say, the board will say, well, we're on the board, we can't look at everything. So they have their own defense, right? But you often see this because it's shocking in a large company, public company, how these things happen also. But right. This is usually the defense. So that's why they have these investigations. But usually, the best is to be proactive in these sorts of situations.
So I think, yes, the related party is one of the most tricky situations that you see, especially in these companies. So while there is a lot of disclosures regarding that is covered in the definitive agreements, but you never know what happens during the course of the operation. So now we have a couple of questions from the audience. One question is to ask more on the founder side. Today we see a lot of founders being sidelined / forced to leave their own firms based on certain allegations. Haven't we seen that in Zilingo? How is the responsibility shared between the investors, boards, founders in such cases? Isn't the founder the easiest scapegoat of the lot? Shantanu?
Is the scapegoat a lot? I don't know about that. I mean, certainly, at least from my view, what you often see is that investors, at least they claim to be investing in people, right? So at some point they had confidence in that founder, otherwise they wouldn't have invested in the company. When certain things happen, they lost confidence in the founder. And at that point, they're too deep into the company to get out of the company, and they have to keep the company going as a business concern. So I find it, it's questionable as to this scapegoat, because their own judgment becomes questionable. That you invest in this company because of the people, i.e. the founder was very important to you. And now that the certain things have happened and it's not. And so I'm not convinced it's a scapegoat, because, and also when you look at this situation, the investors, as the venture funds, they're on multiple boards. They're not really running the company. Mm-hmm. And so I don't know that they are, they're the ones. It would be very unusual if an investor was in cahoots with somebody else in the company to drain money from the company. I would just not have heard of that, but I think anything is possible.
Sure. And Atul, your views on the same?
I think I'll resonate the same views that Shantanu is saying. If you think of it, most of the companies around the world, the early startups today that you still see that Bill Gates is still a pretty rich man, right? Yeah, he was a founder. So I think if you do it right, you will get it right. So, I'll stick with what Shantanu is saying.
But don't in the definitive agreements you see like one of the umbrella clauses which is there is the founder shall ensure that all the business is conducted in accordance with the laws of the land, and that any such material disclosures have to be, the investors have to be updated of. And then there is an indemnity clause as well. Like if it is a non-correctable breach, then the founders are actually required to indemnify the investors.
Yeah, you do see some. I'm sorry, go ahead.
It happens even in a normal sale, right? The seller always indemnifies the buyer. So this is an investment, but Shantanu can say more on it. It's a legal point here.
Yeah, no, I think Atul's right though. In a sale context, then there's indemnification regarding what's happened in the past. The same is true of an investment, Series ABC, what's happened in the past. However, now you're talking about going forward. Let's say in Series B, an investor comes in and invests in, and they like the team, they like the founder, etc. Now between Series B and C, there's something, or maybe C never happens because there's allegations of fraud. Now the question is, what is the what is the liability? Who's got the liability for that? So possibly the venture fund can go and file action against the founder as well and claim an indemnification of that. It's questionable whether the founder has any resources to pay for this thing. Maybe the founder has to. Maybe the venture fund will actually institute or force a sale of the founder shares and basically do a takeover. And I think you saw this in Bharat Pay. That was, I'm just telling you what I read in the press, but the founder basically had to sell some of his stake or reduce his stake, and that stake was sold. And so these are some of the mechanisms, because usually, if you are a venture investor, you invested a heavily sum in the company, you don't want to see the company completely go down in flames. You still have money in the company, and therefore you want it to succeed. You may want the founder to have a much reduced stake and have a reduced role, but you would still force him to maybe buy out his stake, and you would kind of continue to try to clean things up and run the company in a more appropriate manner.
Radhika?
Yeah, I know we're running short of time, but Atul, I wanted to ask you this question, that based on your experience, have you dealt with any of the growth stage or late stage companies where you've audited through KNAV and found any issues?
I guess when we talk about finding issues, yes, there have been situations where we started on an audit and we had to then decline to continue on the audit simply because there was a difference of opinion with respect to the accounting of certain transactions. So those are things that we obviously, when you go through being an audit for a long period of time, that does happen. More importantly, what I can tell you is a very interesting aspect which comes up, because we do quite a few of these SPAC transactions also. And when it comes to a SPAC transactions, I don't know whether you know about it, but the targets originally are audited under the local auditing standards. Let's say in the US, they would be just audited under the US generally accepted auditing standards. In India, under the Indian auditing standards. But then when it comes to actually presenting those financials in the S4 or a proxy, along with the SPAC, you have to present, what are called as, Reg SX financials, which are the SEC GAAP, and also you have to audit under the PCAOB standards. And there is a difference between the GAAP and the GAS both, due to which we see typically quite a few haircuts that happen when it comes to revenues, when it comes to some of the assets, as to the measurement of those assets. So those are the things that we do see happening in terms of some of the clients out there, where you will see that numbers do change. The more spotlight you put on the numbers, you will always find something which can be tweaked or tuned further. So it's a never ending. You tell Abhinav to look at a set of financial statement, he'll find 10 errors which we as auditors might not have even seen previously. It is very much possible. So it all depends on the level of scrutiny that you put on those financial statements.
Right. And like you said, that is never ending. And this session can also be never ending because it has got so much of, content into it. And I'm sure that we'll have to do a second one on that. But we have already ran out of time, but I'd like to thank each one of you for your time. And I'm sure that each one of us has loved hearing your insights. We'll be putting the recording up on YouTube and LinkedIn, so watch out for that. But thanks Shantanu, Atul and Abhinav for your time, and hope you all have a great day ahead, and hope you have a good evening, Abhinav.